It's great questions.
24 seconds away from the opening bow this morning. Good morning. As we kick off a brand new trading week, equity soft, the lower negative by 0.7% after 2 weeks of gains on the S&P. Looking for a softer opening bout in just a couple of seconds' time. On the Nasdaq, we're down by 0.75%. On the Russell, the small caps negative by 0.7%. There's your opening bout. Switch on the board and get to the bond market. 10-year yields creeping a little bit higher, up 7 basis points on a 10-year, 355.35. Bit of dollar weakness out there again. Euro dollar 105.59, euro dollar positive 0.2%, and crude rallying back up 2.9% to $82.30. 15 seconds into this one, the S&P 500 down by 0.75%. On the Nasdaq, we're down by 0.7%. One company to look at around the opening bow, Delta, striking a deal with its pilots after more than 3 years of talks. The two sides agreeing on 31% in pay raises over a 4-year term. The airline saying in an email that the agreement, quote, recognizes the contributions of our pilots to Delta's success. Katie Lyons has more. Hey, Kaylee.
Hey, John, that 31% is obviously a very big number, broken down, as you said, over the course of 4 years. The first being an 18% pay hike when the deal is signed. And again, this is just tentative at this point. It still needs to get approved by union leadership and the members. But then after that 18%, then another 5% the next year and 4% the 2 years after that. And that's just in terms of straight up compensation. There also is factors including quality of life changes like work scheduling improvements. All said, this could amount to $7.8 billion in total increased value. And if approved, it could be the first new pilot contract approved by a major U.S. airline since before the start of the pandemic. And this technically has implications beyond Delta because the terms of this agreement are expected to set minimum standards for contracts being negotiated by American, United, and Southwest Airlines as well. So that could have implications for labor costs, which on average in the industry in the third quarter represented about 23% as a share of sales. For Delta and United, it actually is slightly less than that, but that number could go up because basically they got to pay up if they don't want to deal with the staffing shortages they were dealing with when we first emerged from the pandemic air travel slump. And that, of course, is reflective of what we're seeing in the broader labor market, a remaining mismatch between labor demand and labor supply, and that is what has been driving up wages. We saw this evidence once again in the jobs report on Friday when that wage growth figure surprised both on month-on-month and year-on-year numbers to the upside. And obviously that is not something the Federal Reserve is eager to see as they are trying to cool down the labor market, John.
Katie, thank you. And to pick out one further airline stock, United is up by a little more than 1%. We mentioned that call from Morgan Stanley. If you missed it, they upgraded United to overweight. They said 2023 could be a Goldilocks period for travel following 3 years of extreme conditions. Again, that stock up by 1.2% in early trading. This raises questions. Wages, margins, profits going into next year. The latest payrolls report keeps the pressure on the Fed. Judy Beal of Kayne Anderson Rudnick saying the following: Powell is backed into a corner, but I think he wants to be there. Friday's wage growth numbers certainly make it harder for Chair Powell to argue for a pause or a pivot. Judy, I'm pleased to say, joins us right now. Judy, what does that wage growth story tell you about the potential for margins to contract and maybe markedly over the next couple of quarters?
Yeah, I think we've for sure reached the period of peak margins. We're seeing that across all of the earnings reports that happened in the last quarter or two. We know that that pressure is going to persist and continue. Some businesses are able to price against it, others aren't. But I think if you look broadly speaking, the wage growth that we're seeing is primarily happening, on the front line. And I think that also has important implications for profitability for most of those businesses, which tend to be a little bit thinner margins. I think broadly, the Chair Powell is really in a position where he can't ignore that strong wage growth, and he has to take action against it. And so the idea that there's going to be a major pause or pivot, I think, is pretty unrealistic.
So, Judy, what do you think explains the rally we've seen of the mid-October low, and even the rally after payrolls on Friday, where we gapped lower and then only finished the day down by about 0.1%?
Yeah, I thought that was interesting to see the market's reaction on Friday, where we kind of started with the typical, good news is bad news. And I think we are recognizing that there are going to be fundamental pockets of opportunity. I think the rally is really about coming from a place of, are we going to have 75 basis point rate increases forever? It sort of felt like we were. And so even 50 is an improvement. What I think is really important to keep in mind is that, yes, we're at 4.5. That is not that markedly higher than a 2.5%, which I think is what we would think of as neutral. So I think, yes, we've raised rates really quickly, and that really has had an impact on valuations for, tech companies where, businesses are more sensitive in terms of interest rates. But I think broadly speaking, we're in pretty good shape, and I think that's what investors are recognizing.
So have we seen the end of the bear market rally of the last couple of months? We caught up with a man who called this bear market rally just last week. Mike Wilson had to say this. Take a listen.
We have more confidence that this rally will continue into December. We think rates will go lower. We think, Powell's commentary is right in line with what we've been saying, which is that they're going to pause probably in January. The market's getting in front of that, and this is a classic, kind of Fed pause stock market rally.
This morning, a shift from Mike Wilson over at Morgan Stanley. As suggested 2 weeks ago, for this technical rally to go higher, back-end rates would need to fall. Fast forward to today, and that's what has happened. We are now right into our original upside targets, and we recommend taking profits before the bear returns with earnest. So, Julie, can I come to you on that? The end of this bear market rally, do you agree?
Yeah, I think we've gotten to a point where, inflation valuations look quite full again. And, the outlook to me looks still pretty uncertain. I think holiday is going to be a big driver of sentiment going into 2023, and I think the results so far for, Black Friday have been pretty mixed. So I think looking forward, it's more important to understand that where consumer demand is and the strength of the consumer overall. We're seeing them come back into their credit cards. They've spent down a lot of their savings. We need a strong consumer really in order for this economy to work. So if there's any hint of that, I think the bear market returns in a meaningful way.
So Julie, how do you play the retail names? You've been on top of that story for several months for us. How do you play them now?
I think still I like off-price the best because they've been the ones that have been the most impacted by supply chain in a negative way. They are the ones who depend on our having an excess of goods to sell, and we're finally going to be in that position. All we hear about is, oversupply of inventory. I like a little bit less the fashion-focused off-price because I do think if the consumer weakens, you're going to want more general merchandise. So I like a company like Ollie's Bargain Outlets, which is more kind of general merchandise, but still close out great bargains.
I'd love your view on some of the big tech names as well. We spent a lot of time over the last several months talking about austerity coming to Silicon Valley. Julie, does that make you a little bit more constructive on some of these big names?
The larger names, I think, still have challenges ahead of them. It's very unclear to me what the ad market is going to look like, but I would still rather have exposure to, a Google, which has a straight-up monopoly, than necessarily an Apple where you're asking customers to pay $1,000 for a phone. I think those are inherently different businesses, and so you have to look at big tech on a case-by-case basis on what the fundamentals really are.
I was looking at some of your top picks. There was one name, and I'll let you share that name with our audience. You said it's faced multiple downturns, it's got public sector exposure and less cyclicality. Julie, what name is that, and why is that name going to do well?
That's the company Tyler Technologies, and it's a software business that caters strictly to, municipal governments. It really is able to speak to them on a one-to-one basis. I've actually worked in a municipal government, and if you could buy pens that were just for municipal employees, they would. They want everything to be tailored for their business and that understands their constraints. And this business is run very conservatively, and it has high levels of recurring revenue so they can plan if there is a downturn.
And you're confident in the finances of the people that fund that company, the municipals behind it?
Yeah, I am actually. I think generally speaking, even through downturns, there's still less cyclicality. Housing is going to have to correct in certain places, but broadly speaking, they tend to do okay. And more importantly, they just need the IT support that these businesses have. They're retiring COBOL programmers, right? So they depend on businesses like Tyler to kind of outsource their IT to run their business.
Julie, this was awesome. As always, it's good to catch up. Julie Biel there breaking down some of her top picks in this equity market. About 8 or 9 minutes into the session, we're down by just 0.5% on the S&P. Underperformance from consumer discretion, we're down there by 1.2%. The outperformance on energy up by more than 1%. Coming up, an OPEC decision in the face of an uncertain demand picture.
China and Asia picking up the baton will just create a lot bigger deficit. So some volatility in the near term, but then upward trajectory for oil prices should resume from next year.
And that conversation up next.
Just last week, you've seen 17 million barrels of draws across US, Japan, and ARA. So draws are picking up as the SPR slows down. And yes, Europe and US will slow down. It's already in our numbers. But again, China and Asia picking up the baton will just create a lot bigger deficit. So some volatility in the near term, but then upward trajectory for oil prices should resume from next year.
OPEC Plus holding output steady amid surging volatility. The decision coming as EU sanctions on Russian crude kick in, capping oil potentially at $60 a barrel. In the US, the GOP looking into reports of a failed secret deal between President Biden administration officials and Saudi Arabia to boost production. The team coverage begins right now with AMH down in DC and Julian Lee in London. Julian, first to you, the OPEC decision. How is that one going to evolve going into next year as China looks to reopen?
Well, I think the group is going to keep on top of the market. They clearly don't want to see oil prices going down. The question is going to be if prices start to rise, at what point are they going to step in and open the taps a little bit more, perhaps reverse some of the cut that they put in place for November. I think that Asia is certainly going to pick up as China reopens, as Amrita Sen said earlier. The big question is, how much can China grow if the rest of the world is contracting and the demand for Chinese goods is being hampered? That's something I think that we're all going to have to watch. And I think the producer group, they're always slower to raise output than they are to cut it. They're slower to defend against the upside of oil prices than the downside, but I don't think they want to see them rise too far.
Well, Julian, they've talked down spare capacity. Just how much spare capacity is there to respond to potentially, and I say potentially, a pickup in Chinese demand?
Well, I think that's, that is one of the big unknowns. Saudi Arabia has cut, we think, about 500,000 barrels a day from its production over the past month. It clearly has that and possibly another 1 million barrels a day on top of that. The United Arab Emirates probably has maybe around that much, perhaps a little bit less. Kuwait may have a little bit, but probably not very much. And after that, you probably don't have a great deal of spare capacity in the OPEC countries at all.
Anne-Marie, I want to come to you on the latest report that we're reporting. The House Republicans announced a probe into reports of a failed, quote, secret deal to boost oil production between White House officials and Saudi Arabia. Anne-Marie, can you walk us through that link between the two?
Well, Jonathan, what we have is this letter last night, which is a probe, and we should say one of many that the House Oversight Committee, and this is going to be falling into the hands of the Republicans come January, with the majority that they have in terms of energy policy in the Biden administration. And what this letter says is, as you mentioned, they're investigating reports of a, quote, secret deal between the admin and Saudi Arabia. They point to this New York Times report that they say the Biden admin officials believe Biden's trip to Saudi Arabia in August of 2022, quote, could shore up a Saudi commitment to convince OPEC to increase oil production. I think that was pretty well obvious to everyone witnessing that trip, on that trip, and also the U.S. reaction when the group decided at their last meeting, yes, this meeting, as Julian says, they kept it steady, but the last meeting they cut 2 million barrels a day. So you're going to see a lot of questions from the Republicans about this, Jonathan. I would just say that whether you're a Democrat or Republican, the White House has always in the past had to deal with Saudi Arabia because what the White House of any administration cares about is the price of oil because they care about the price of gasoline.
If that's what the White House wanted, as you indicated, they didn't get it. And Anne-Marie, this week there is a meeting between Xi and leadership in Riyadh. AMH, how do you think this is going to play out in the coming days?
Well, energy and oil is the absolute bedrock of the Beijing-Riyadh relationship. Saudi Arabia is China's main #1 crude oil supplier. As you and Julian are talking about, there's a lot of questions about what potentially easing of COVID restrictions could mean for Chinese demand. But we also should note, speaking of the president's trip to Saudi Arabia in the summer, he said he did not want to leave a vacuum in the region for Russia or China to take that over. And Xi obviously has been trying to make inroads in the Gulf, whether or not it's Riyadh or Abu Dhabi, etc. And what you have here is obviously energy critical for both these countries, but also they are looking at other avenues that they potentially could explore. Technology for one. What happens with 5G and Huawei? Saudi Arabia is in talks with China. There's also a Wall Street Journal report earlier this year, Jonathan, about moving away from the U.S. dollar and maybe paying for oil in yuan. There's going to be a number of other avenues that likely you're going to want to look at when they announce readout of this meeting, which, by the way, we're still waiting for more details from Beijing and Riyadh on what they plan to discuss.
Julian, could we get a final word from you on that, this relationship between China and Riyadh? You and I were talking about the potential for Chinese demand to come back online, the spare capacity that Riyadh maybe has or doesn't have. Walk me through what you're focused on as these two leaders meet later this week.
Well, I think, one of the big focuses is going to be on Saudi Arabia's place in China's oil market. The kingdom, along with the other traditional suppliers in the Gulf region, have come under increasing competition in China from discounted Russian barrels that are being shunned in Europe. The start of this EU ban on crude imports from Russia is only going to intensify that competition for crude oil markets, both in China and also in India. And I think that relationship between Saudi Arabia and China, as Anne-Marie said, is absolutely the bedrock of their political relationship, and it's very important both to Saudi Arabia, but also in the long term, I think, to China too.
Julian Lee, thank you, sir. Out of London, AMH down in DC, crude this morning. Brent up by 2.2% to $87 and about 50 cents. WTI up by 2.5% to just short of $82 a barrel. Some economic data out moments ago. Let's get to Mike McKee for more. Hey, Mike.
Morning, John. I have some very, very, very little good news for you on this. The S&P Global indexes for PMIs are out for services and composite, and they're both higher, but not very much. Services comes in at 46.2 after 46.1, and the composite PMI comes in at 46.4 after 46.3, so not much change there. Market participants much more likely to be watching the ISM services numbers at the top of the hour. The headline number supposed to remain comfortably over 50, but people aren't really going to care so much about that as they will about prices paid and prices received, wither inflation in the services industry. And other than that, John, I would tell anybody who's trading on the economy to go home for the rest of the week until Friday. Make a late breakfast, sit in bed, watch the Open with John Farrow.
Thanks,
wait
Mark.
till Friday, because we don't have a lot of Fed or economic news this week that's going to move markets until PPI on Friday, and we also get the University of Michigan. Everybody watches the consumer sentiment about prices and inflation. Pretty quiet week ahead is kind of what I'm saying.
I was going to ask you for ISM services, just a teaser in 10 minutes. Are you saying that doesn't matter?
No, the headline isn't going to matter, John, as much as the prices paid. We do want to see new orders and see that ISM services are hanging in. You don't want a recession signal from that. But it's inflation that's driving the Fed, and inflation and the Fed are driving the markets. So we'll want to see whether inflation in services is starting to fall. That's what Jay Powell said he's watching these days.
Do you like it when there's a quiet period, Mike, for the Fed? They're in that quiet period right now. No Fed speak. Is that a good thing?
That's a good thing, at least from volatility standpoint. We don't have a lot of ups and downs based on the Fed. People can trade on other things.
Next Fed speak next week. Chairman Powell in the news conference. Mike McKee on top of that for you. Day before that, this is kind of the runway into year end, just as far as the schedule's concerned. 13th CPI, 14th Federal Reserve, 15th, if you care, if you're interested, the ECB on the 15th, a day later. Right now, about 21 minutes into the session, we're down by 0.75% on the S&P. On the Nasdaq, we're down by about 0.5% with your sector price action. Here's Abby.
And John, we're looking at a third down day in a row. Anemic volume, though, once again, and we break it down sector-wise with that decline. Not surprisingly, more sectors than not are down. Starting out on the top on that energy story that you were just discussing with Julian Lee and Anne-Marie, we do have oil higher right now, reacting to that OPEC Plus holding output steady. That's helping the energy sector, but just a little bit at this point, really off its highs, up 0.3%. Consumer discretionary weighing the most, down 1.6%. Amazon, Tesla in there. And then it's interesting, financials down once again, even though you have the yield curves coming up just a little bit, yields up, that should help. So not a lot of rhythm and run, but most sectors are lower. One sector I'd really focus in on, though, is the China tech sector, because it is off to the races once again. That Hang Seng tech sector in the Asian session up 9.3%. The Golden Dragon China index at this point up 0.9%. Bilibili up 4.8%. John, that stock over the last couple of days up 170%. It's trading a lot like a meme stock, but there were good earnings there. And then Baidu up 1.1%. And this, of course, has to do with more progress around the China reopening and folks thinking that that economy is really going to pop open and help some of these stocks.
Abby, thank you. Abby mentioned that push higher in yields. 10-year yields up 8 basis points to 357. 2-year yields up 5 basis points to 432. Coming up, the trading diary. I'm next. 25 minutes in, we're down 0.75% on the S&P. On the Nasdaq, we're down about 0.5%. Equities down, yields up. You see that right the way through the curve. 2s out to 30s, 2s and 10s look like this. Up 5 basis points on a 2-year, 432 on a 10-year. Up 7 or 8 basis points so far, 356 on a US 10-year. That's the price action. Here's the trading diary. Next stop, top of the hour, ISM Services coming right up. The Senate runoff election underway in Georgia on Tuesday. China's President Xi in Riyadh for a summit with Saudi leaders on Wednesday. Look out for that. Another round of jobless claims on Thursday. Mike went through the data for the week ahead for you. PPI and UMich Consumer Sentiment Survey to close out the week on Friday from New York City. A quieter week this week. That's what we expect, we hope for, going into a busier week next week with CPI and the Fed on deck. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is
30 minutes into the U.S. trading day, Monday, December 5th. Here are the top market stories we're following for you at this hour. Time to sell stocks. Morgan Stanley says the recent rally doesn't have much legs and to sell the rip. We're going to try and see if markets get a Grinch or Santa for Christmas. And China reopening. No, for real this time. China eases testing restrictions in outdoor places in major cities as the government eases away from its zero-tolerance COVID policy. And Monday's data dump. We're going to get the latest read on the U.S. economy with the ISM Services Index, and we're going to have instant analysis with Anthony Nieves, chair of the ISM Business Services Survey Committee. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets, if I can talk on this Monday morning. Guy, I got to point out, we're really rolling over here in the markets. The S&P down a full percentage point. We're seeing a sell-off in the bond market, and the dollar starting to gain a little bit of steam here.
Yeah, it's hard to put it all together, isn't it, and try and understand exactly what is happening. We are coming into year-end. I do wonder whether all of that needs to be borne in mind as well. The China story I would have thought would be reasonably positive.
Yeah.
But the data, I think, are all over the place at the moment. I think this is where life starts to get a little bit confusing. The ISM number is out. Services, we know, is a pretty strong part of the economy, and it's really holding up. Let's get a read on it with Mike McKee.
Well, Guy, you're right. It's good news this morning on the services standpoint. At least here in the United States, the ISM Services PMI goes up to 56.5 from 54.4. That was not expected. A slight drop was what was priced into the markets. Business activity still strong at 64.7. That's up from 55.7. New orders drop a little bit to 56 from 56.5, but that's also still strong. The number that everybody wants to know, though, is prices, and prices paid come down, but just a little, to 70 from 70.7. So not a huge improvement there. But backlog of orders ease a little bit. New export orders fall a little bit. That may be a dollar impact. So overall, the news is pretty good from the services sector. Now the question is, does that mean they're still hiring? Does that mean that we're still going to see wage price pressures? Mm-hmm. The employment number goes to 51.5 from 49.1, although that doesn't really tell us much because we already got the numbers in the payroll report on Friday.
Yeah, really interesting stuff. And then no doubt this is a good news for the economy, bad news then for the market. That bond sell-off really picking up steam. You got the 10-year up by 10 basis points, and then S&P decidedly below now. Its 200-day moving average up by 1%. Let's get more analysis here, Mike. Thanks a lot. With Anthony Nieves, chair of the ISM Services Business Survey Committee. Anthony, focus on the employment part of it because that's going to be the real puzzle then. What is leading the strength in the employment within the ISM?
Well, we are coming back from a month of contraction, and we've seen the growth here. As was mentioned, it's 51.5 up from the 49.1. And there's been hiring in the retail industry, as well as we have a couple things going on here. We have a combination of some companies looking to hire and not being able to backfill positions because of the lack of availability of suitable workers for those type of open positions. Most notably, we see that in the customer-facing industries like retail, accommodation and food services, restaurant workers. Still a tough time for them in backfilling their open positions.
Anthony, good morning. It's Guy. Talk me through the inflationary read from this data. You've got the prices paid number. Alex has already referenced the employment index. Talk me through what the signal I should be taking away from the data.
Great question. I think that when we look at the variables that comprise us moving into a recessionary period, we still have strength in the employment numbers. We know that from not only this report, but the non-farm payrolls report that came out on Friday, as well as we see growth. This represents over 80% contribution to GDP, these 18 industries that comprise this sector. The one variable that we are looking at now is the inflation piece, and prices are still very high. As it came down just 0.7 percentage points, most of that was driven by the reduction of fuel prices, but overall, we're still seeing high commodity prices, and until we see that easing, it's not going to be any time soon that we see the prices come down a bit.
Yeah, Anthony, you mentioned retail, though, being strong for employment, which then obviously impacts wages. But the retail industry in the jobs report on Friday saw a loss of about 30,000 jobs, and department stores are also losing jobs. Do these two data points match up, or is there something seasonality-wise going on here?
We do measure this, and we do apply seasonality to this as well, especially at this time of year with the holiday season. But overall, we're measuring directional change month over month. So we could have an increase like we did in this report. It doesn't mean that when we look at it 6 months back or a year over year that there's been growth in that particular area.
Anthony, what is the signal do you think the Federal Reserve should take from the data you just produced?
I think they'll continue to raise interest rates, but they won't be as the high levels that we've seen in the past. I think that they're just trying to stave off inflation, and that they will continue to increase the basis points on the interest rates, but hopefully not with the jumps that we've seen in the past.
All right, Anthony, thanks a lot. Really appreciate you jumping on with us to break all this down. Anthony Nieves of ISM, thank you very much. S&P up by 1%. Coming up, Mona Mahajan, Senior Investment Strategist at Edward Jones, is weighing in on our question of the day. Is it Grinch or Santa for equities? Right now, it looks like Grinch, but we'll get her take. This is Bloomberg.
Tomorrow, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
They basically picked negative growth around 1% or so for the first 3 quarters of 23, and then it comes back to positive growth. That means the year is negative overall, but it's just 1%. So you think about the recession, when we were sitting here, we went down 30% that next quarter and stuff. So this is a more mild recession.
That was Bank of America CEO Brian Moynihan forecasting a mild recession next year. And that leads us to our question of the day, Grinch or Santa for equities? Well, joining us now to help answer the question is Mona Mahajan, a Senior Investment Strategist at Edward Jones. So just my way of understanding what's going to happen in the next 4 weeks.
Yeah, it's a good question. And look, I think we've had a very strong run in Q4 thus far. In fact, the Dow Jones was up nearly 20% since that September 30th period. So yes, we're headed towards a seasonally strong part of the year, but perhaps some of that was front loaded already. We're starting to see a bit of volatility. And keep in mind, in years where there is a lot of tax loss harvesting, December can be a volatile period. But the Santa Claus rally that we typically refer to tends to be that last week in December, the first couple of days of January. Treasury. And that, in our view, can be strong, especially if investors are positioning for the year ahead. Now, keep in mind the two key factors will be the data points we're getting next week, which is, of course, Tuesday's CPI inflation reading and Wednesday's big Fed meeting, which will also come with a new set of economic projections. Now, if those are better than expected, I think we're set up nicely for a year-end rally. And then we start thinking about first quarter and second quarter of 2023, which we think can be softer and more volatile.
Mona, good morning. It's Guy. Do you think Santa Claus is a big fan of charts? Because we're coming up against some really key levels right now, particularly on the S&P. Do you think he's going to pay attention?
Yeah, look, we did briefly move above that 200-day moving average on the S&P 500. Santa may have liked that move, but the key question is, will it hold? And in fact, that is a pretty strong technical indicator, especially if we can stay above that 200-day moving average. But we think the fundamentals remain key drivers of the move in markets broadly and over time, over the long term, not necessarily the charts. And the key driver, of course, this year and next year is what happens with inflation. And the good news, perhaps, is that we're still seeing leading indicators of inflation showing signs of moderation ahead.
So you're definitely not alone in this kind of call. Mike Wilson at Morgan Stanley had his note out this morning. He's been really right for a while, and he suggested that the tactical rally could go higher. He said that a couple weeks ago, and the back-end rates would need to fall. And then today, that's what happened, and we're now right into our original upside targets. Recommend taking profits before the bear returns. This is appearing, Mona, to be a little bit consensus that the first half of next year is going to be tough. The second half then will be a lot better. Is it that binary? Do you see that evolving?
Yeah, usually when the consensus is all moving in one direction, the opposite tends to happen. So it is tough to call first half, second half in a meaningful way. But, from a fundamental macro perspective, we are seeing that mild recession that Brian Moynihan referenced emerge in that first half of 2023. And in fact, we also see so far not the case for a deep or prolonged recessionary environment, but we will have this lag impact from nearly 500 basis points of Fed rate hikes in 2022, and we think that comes to fruition in the first half. But keep in mind, that means part of what's happened in markets have already reflected this recession ahead. And I think we've been all talking about how the move lower, 25% drawdown in the S&P in September really did reflect probably a mild, not deeper, prolonged recession. Now we're back up. The S&P has moved about 10% as well. So we do think the risk reward is once again skewed as we're heading toward an economic slowdown potentially. Historically, markets do bottom in a period of recession, but keep in mind, markets can actually move and recover before the recession ends. In fact, 3 to 6 months prior to recession ending, we could see that recovery playbook come into play for S&P broadly, but also markets as well. And we think that's good news for bond investors and equity investors.
Europe's probably already in a recession. Rest of the world, when it comes to equities, wiping the floor with the US right now. Mona, do you think that trend continues?
Yeah, it's a good point. Valuations have been looking more attractive abroad. And of course, we're seeing this trend of a softer dollar over the last few weeks as well. We do think if that softer dollar trend continues through 2023. And if the recession abroad happens early, we could start getting a recovery earlier in Europe as well. And keep in mind, part of that story will really lie in what happens with China. And we're starting to hear more chatter about how the zero COVID policy may be easing. If demand in China picks up, that will help not only the broader Asian region, but the European economies as well.
Well, that's what's kind of confusing today, because we got real evidence that the reopening in some capacity is happening, and I didn't really feel like markets reacted that much. How much of that part is already priced in?
Yeah, I think one area that we look to is the oil and energy markets, because the demand from China drives a lot of that. And today we are seeing WTI back up above $82. And so I think we'll certainly start to see the commodity trends move accordingly as we start hearing more chatter out of China. So that's one mechanism that we're watching. But I do think more broadly, if we start to see a global recovery, the US dollar is another mechanism. And in fact, in periods where the global growth is softening, the dollar tends to be that flight to safety. If it's stabilizing and starting to improve, that's really when we could see softer dollar trends, which will help, of course, not only China, but broader EM.
Mona, equities get all the attention, the bond market, credits, Maybe that's the place we should be looking. How should I be sequencing? How should I be thinking about how I'm going to sequence back into some of these markets? Is it duration, credit, equities? Is that the way of thinking about things?
We like that order. I think generally what we're seeing set up for next year is that we're starting to get this backdrop where bond markets are looking more attractive than they have in quite a long period. And I think it's not only because we have yields that are, of course, starting from a higher point, which is a good signal of forward returns over the next 12 months, but we're also seeing credit broadly hold up better. And in fact, if we do get a period where, Fed funds peak, yields peak, and then start moving lower, you have this opportunity for price appreciation in bonds as well. So we would say a lot of investors were concentrated in the short end CDs, 1 or 2 year treasury bonds. It's probably a time to start thinking about complementing that with longer duration fixed income, particularly in the investment grade space where we think there's more opportunity. We would wait to add high yield before, until we start to see how this economic downturn unfolds. But we do think the opportunities in fixed income are pretty attractive here.
So for the base case then, as the economic downturn does unfold in the first half of next year, does it stabilize with rate cuts? What's going to be the stabilizing factor, which will then sort of dictate how you can invest in credit and allocate?
Yeah, that's a great question. And we think what will dictate it is the path of inflation. That's, of course, not only keeping the Fed on its toes, but global central banks on its toes as well. And so, of course, we continue to see inflation actually rolling over pretty steadily. It won't be in a straight line downward, but when you look historically, when inflation starts to moderate, it does so pretty consistently, but it does take time, anywhere from 12 to 24 months to return to trough levels. But if we do see this trend, maybe 3-4 prints in the right direction, we think the markets will very quickly then start to think about not only a Fed pause, but when they can start moving back to more neutral territory, which we think they'll start to signal by year end. And so as we move towards the back half of 2023, we think the backdrop is then set for not only a peak in yields, but a move lower in yields, which will really drive markets both in equities and bonds.
Mona, great to catch up. Really appreciate the insight. Thank you very much indeed.
Thank you,
Mona Mahajan of Edward Jones. Can I just point out, Mona's got the Christmas tree up. She's definitely on Santa's side. Alex Steele, not so much. Maybe the Grinches.
But if I put it up now, by Christmas it would look gross. Don't you need to keep it fresh? I don't understand.
Just got to keep it watered. Water the tree.
Yeah, but even still with the heat on in the apartment, no, we're doing it at the 17th. This is when we're going to do it. And then it's going to be really fragrant and lovely for Christmas.
Okay. I'm just saying, for now, Grinch.
For now, I'm the Grinch.
Not Santa.
Fine.
Okay. It's usually my role. Still ahead, Tesla is said to be planning to lower production at its Shanghai factory. We're going to explore what this means for the EV giant next. We're going to take you to San Francisco. This is Bloomberg.
The labor market is strong, and we're still in unprecedented territory in terms of the gap between vacancies and jobs. And I think that what that's got to tell you is that we got a long way to go to getting inflation down where the Fed has said that it wants it to be.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Shares of Credit Suisse rose today on the prospect that Saudi Arabia's Crown Prince Mohammed bin Salman will take a stake in its investment bank spin-off. Bloomberg has learned that bin Salman may invest about $500 million in the unit, which will be known as Credit Suisse First Boston. The Saudi National Bank is already an investor in Credit Suisse's $4 billion capital raise. Shares of gaming company Activision Blizzard are higher. That after Bloomberg learned that Microsoft is ready to fight for its $69 billion acquisition of the company if federal regulators file suit to block it. The Federal Trade Commission staff is wrapping up its investigation of the deal. And Elon Musk says Apple has finally resumed advertising on Twitter. The billionaire revealed the news during a Twitter Spaces conversation over the weekend. He added that Apple is the largest advertiser on the social media network. Last week, Musk blasted Apple, saying that the tech giant had mostly stopped its ads on Twitter and threatened to pull the site from its app store. And it's another sign that demand for Teslas in China isn't living up to expectations. Bloomberg's learned the electric car maker plans to lower production at its Shanghai factory. It's estimated the move could reduce production by about 20%. And that is your latest business flash. Alex.
All right, thanks so much, Ritika. It's about 21 minutes past 7 in San Francisco. I want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-anchor Ed Ludlow. Ed, let's start with that Tesla story.
Yeah.
It feels like they're conflicting reports. Are they cutting production in the Shanghai factory?
Yeah, so according to sources, they're cutting by 20% from full capacity. One source told Bloomberg that they'd made an assessment of near-term demand, particularly in the domestic Chinese market, right? This is a facility that builds 750,000 or has installed capacity to build 750,000 EVs a year, split between Model 3 and Model Y. And if they do so, it's significant because it's the first time they'll voluntarily cut output, which is why we're kind of drawing this link to the question of demand in China. It's worth noting Tesla had a record delivery month in November, more than 100,000 vehicles or EVs to the domestic market in a single month. So there are interesting points and questions over it. This is a plant that has anyway experienced fluctuations and impacts from supply chain crunches and the shutdowns. And as we reported over the weekend, in Shanghai in particular, that's a city that authorities are starting to pare back their COVID restrictions. So it's certainly one to watch.
Ed, is it just domestic that's the problem here? Or are we seeing maybe demand elsewhere starting to fall off a little bit as well? We're also seeing the rise of other plants too. Berlin obviously is one that is notable. How does this change the mix in terms of what Tesla's producing globally?
Yeah, the mix is important because as a rule, Tesla's commented on earnings call, when the mix or things are smooth in Shanghai and the mix is higher towards, for example, Model Y, then the bottom line improves, right? That's good for margins. The demand one's interesting. Joseph Spag, RBC, has a note out that, even if there's questions on near-term demand, the one lever that Tesla has at its disposal is price adjustments, right, in all markets around the world. The ability to cut or raise prices, or in this instance, to cut prices as a lever to boost demand. So it's certainly an interesting one. What I would say as well is, in China, there are many more EV players offering many more models. It's a competitive market where there's a lot on offer to the consumer, but Tesla's done really well to battle against some of those domestic players. Pricing is a key mechanism in that.
So, Ed, the stock is off 5%. Is this headline worth 5%, or is there something else going on here?
Yeah, I think that's interesting. You also have to remember you can't strip out Tesla with what's happening with higher rates than the Fed. We always talk about Tesla from the demand side of the equation, but they're also a valuation question as well, right? You go on the Bloomberg terminal, look at its forward earnings. I think we're trading at 30 times forward earnings on Tesla right now. So that's a big focus ahead of Wednesday. It's multiple. But also, ongoing disruption in China is still a big question mark, right? If you take Zhengzhou and Apple as an example, yes, restrictions are being lifted in key cities, Shanghai, Zhengzhou, Hangzhou, but we're also seeing Foxconn, for example, come out and say we're still operating within a closed loop. We see businesses still struggling to deal with this issue of keeping the spread of COVID-19 under control while keeping their factories operational.
Should we worry about Foxconn reporting that big sales drop? What does that mean for Apple?
Yeah, what was really interesting is that 11.4% drop year on year in sales, but they said the commentary was that this November just gone was the most COVID impacted to date. If you think about the story of the last 2 years in the pandemic, we're only now seeing real impact to Foxconn's abilities. The Journal reporting over the weekend that Apple's told its suppliers to accelerate plans to move supply chain away from China towards India and Vietnam. It's hurt Foxconn. Go on SPLC Go on the Bloomberg and you can see how reliant Foxconn is on Apple in terms of revenue. But it is worrying. That said, you know, they did say they're operating in a closed loop system, but they were also talking about, in the context of protests and COVID disruptions, that things are under control right now. So we'll have to see how long that lasts.
As ever, Ed, fantastic stuff. Thank you very much indeed. Bloomberg Technology co-anchor Ed Ludlow joining us from San Francisco. Coming up, we're going to switch to what's happening in the oil markets, from EVs to the oil market. The West tightening sanctions on Russian crude. We are going to talk to Hagar Chemali, Greenwich Media Strategy CEO and former Treasury Senior Sanctions Policy Advisor, about the implications of all of this. That's next. This is Bloomberg.